So, good evening to all of you. Today, in this auspicious day of Mahapanchami, we will be having our BFSI board webinar, and we are very much honored that today we have the presence of Madam Sumitra, R. Sumitra Raghavan. She will be delving on the topic of CMA's role in receivables audit, stock audit, and monitoring of end use of funds. Before we just hand over the session to Madam, just to say that CMAs have a lot of important roles in various assignments. We are doing stock and receivables audit. We are also having forensic audit. We also part of this TEB studies, credit monitoring. We also do valuation of business financial assets. Risk-based internal audit. We are also having various expertise and also restructuring and various resolution assignments. CMAs are equipped through IBBI, through insolvency professionals. Apart from that, various certification work CMAs are eligible to do in various assignments of project costing and working capital management. Before we just start with an auspicious note, we start with our institute anthem.
ततो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय.
A short profile of Madam R. Sumitra. She is credit management specialist. She is the speaker for today. She is a seasoned banking professional with over 15 years of experience in corporate credit and MSME financing, having experience in credit appraisal, risk management, and asset valuation with a leading public sector bank. She has also served as a full-time faculty member, training banking professionals across the country. Madam is an MBA in finance. She is also having a lot of certifications. She is having certified fraud examiner from ACAP USA, certificate in specialist in demand guarantees, which is CSDG from LIBF UK, and certified documentary credit specialist, which is CTCS from LIBF UK. She is also a guest speaker in various reputations across India and also faculty of our certificate course on credit management. With this short profile, I welcome Madam for today's session. And before I hand over, our chairman sir will be joining any moment. I request uh, Partho sir, who is our advisor and former CGM of Reserve Bank of India, to start his special address. Over to you, Partho sir.
Thank you, Dibbindu. Namaskar to everybody. Now, our chairman will be joining shortly, but respected speaker today, Madam Sumitra, the officials from BFSI, and the participants. It is a great pleasure for me to be addressing this particular webinar on three very important aspects, that is receivable audit, stock audits, and monitoring of end use of funds. Now, as Dibbindu has already said, that the CMAs have a great role to play in it. Absolutely correct. I fully agree. As I have spent quite a lot of years in Reserve Bank on the supervisory area, I just want to flag a few of the issues that why it is so important, why receivable audit is important, why stock audit is important, etc. So good that I have got this opportunity to share my views. So let us start with that receivable. Now, we appreciate the view that receivables are the bloodline. If we do not have a consistent flow of receivables, no enterprise can survive in the long run. So we often land up in a scenario where the business is growing, balance sheet size is growing, but the income or the profitability have not growing. Why it can be? Apart from the other aspect of provisioning, etc., losses, that's fine. That is the operational risk part. But often it is found that the receivables, as projected, estimated, are not actually flowing into the organization from the business aspect. So what is required to get a realistic assessment of the receivables? Accuracy in calculation, the very existence of a flow of receivable, actual flow of receivable, and the valuation part of the receivable. If these three are not on factual terms, then the receivable flow will be not as expected by the management of the company or any entity. So it is also very much applicable for banks. So what is to be done? A thorough evaluation, audit of receivable are very much on the card, just to ensure that medium and long term viability of the operations. When I talk about from the lender's point of view, the borrower's very existence in the long run depends on how good and reliable the receivables are, how well it is accounted for. Is there any leakage? From the borrower's point of view, how can I establish that I am having a long term viability if my operations are not generating enough amount of receivable? So, from either side, keeping a close look at the accounting standards, receivables should reflect the actual outcome of my business. And there lies the importance of the audit of the receivables. I will stop here because I expect Madam will be taking further deep into the receivable auditing and receivable management. So I will now move on to the other aspect of stock audit. Now, inventory audit, stock audit. Why I am so concerned about what is in my stock? The basic questions we should ask ourselves. Auditing, accounting is fine, but why it is that important? Again, from a banker's point of view, from the lender's point of view, the stock which is available with the borrowers, which is related to the credit facility given by the lender, actually determines the quantity of the amount which I am going to lend. If that is impaired, then the very structure of provision of credit, the repayment of the credit, so-called collateralized credit, is in jeopardy. So from a lender point of view, I must know that if the borrower says I have 100 rupees of goods in my warehouse, whether it actually worth 100 rupees. If I am not sure about that, then certain day-to-day operational credit facility, I am not in a position to get a realistic estimate of his requirement. So from that point of view, the establishment of the correct value of the audit stock is very much a requirement. Reserve Bank has long back and continuously talking about a very realistic estimate of the stocks offered as collateral for a business loan by the entities. For example, I can cite that Reserve Bank was rather, I will say, constrained to issue this direction, saying that for a non-performing assets of above 5 crore, the stock audit must be done by an external agency. Why an external agency? Just to get the confidence of an independent valuer, independent auditor, who is no way related to the borrower's interest. So that is the significance of stock audit as far as the regulator and supervisor is concerned. Now, let me just briefly touch upon that CMS has a tremendous role to play in conducting the stock audit. Further, I leave it to our respected speaker to carry on the significance and the contribution a CMA can make. Now I will move on to the third issue, end use of funds. I need not give any more emphasis on that how important it is. One of the most critical factor for a good project, a operationally viable project going haywire is diversion of funds. In short, a borrower should ensure that appropriate amount of credit at the appropriate time has been provided for the specified cause. Now, the specified cause part of it is the end use of fund. If as a borrower, I am not sure that the money given by me to a borrower, whether it is used for the purpose for which I have given or not, the entire credit evaluation process is futile. I have evaluated a project, I have found it viable, I found it that yes, funding of this project is going to contribute towards my profitability and the borrower's profitability, and then I found out that the entire money has gone to somewhere else for some other purposes. I'm not even talking about the legality of that purpose in which the fund was actually used. Whether it is legal or illegal, I'm not getting into it. I'm just getting into it. The funds were used for a purpose which was not for which I have given money. This is absolutely no from the regulatory and supervisory point of view. So, what is to be done to ensure this? A very strict monitoring of the end use of fund. You call it monitoring, you call it audit, whatever way you call it. At the end of the day, it has to be monitored on a really day-to-day basis that there is no unauthorized use of that fund for any other purposes except the one for which it is given. So, when we sum up, we have to be very sure that there is receivables realistically estimated and flowing to the extent expected into the company's accounts. We have to ensure that the assets, stocks provided by the borrower as a collateral actually reflects the amount which is stated to be with what, and third, the entire process in which banks' funds have been used or the one for which the credit facility was granted. So this is the gamut of the audit of these three from a regulator or a supervisor's point of view. Now, in this backdrop, it is really a great opportunity to listen Madam Sumitra today, who is a specialist in credit management and having a huge experience in the commercial banking. We are very keen, Madam, to listen to you that what are the things which we should be looking into as a CMA when we are giving this assignment of looking into the one of the most crucial aspects of credit management. I'm sure that the participants will be immensely benefited from these deliberations. And I really thank BFSI board for arranging such a webinar, which is in nowadays is very important, especially when we are going end-to-end digital credit, end-to-end loan sanctioning, collateralization in a completely digital platform. So we have to be very choosy about when we will accept a digitally submitted statement or when we are going to check it whether the digitally submitted statement actually reflects the truth. It is going to be a very challenging one looking ahead for all the CMS. I will stop here. Thank you very much for your time. Jai Hind. Back to Dibbendo.
Thank you, Partho sir, as always, for your thought-provoking, erudite special address. Now we have, in spite of busy schedule, Chittaranjan Chattopadhyay sir, who is chairman of BFSI board, and I request chairman sir to give his special address also.
Thank you, HOD and Secretary of BFSI, Dibbendo Roy, our advisor to BFSI board, CMA Partho Chaudhary, and our today's speaker, Madam R. Sumitra, and all our fellow CMAs and participants. Good afternoon to all. Today's webinar, it's very important because we have got a lot many queries from the members about the stock and receivable audits, how they should be conducted and how they, and many of them have posed many questions to us. I think this is the best occasion. We have chosen this before is Navaratri is going on. So when Madam could get a time, we could understand that maybe in the festival days people will be, maybe they will be listening to this. And of course, I understand that our members are very much eager to understand the role, and many of the webinars we are finding that they are very much useful for the members itself. The last we had a lot many programs, and maybe BFSI board is the only board here that they have got the highest number of webinars we are doing. Last year we have done. So today's session on the CMA's role in receivable audit, stock audit, and monitoring of end use of funds. I must say that one thing we have to understand that India's banking system shows clear improvement in headline asset quality. Gross NPS for public sector banks fell from 9.11% in the March 2021 to 2.58% in the March 2025. Yet, beneath the headline, receivable stress, inventory distortions, and end-use lapses continues to shape farm level liquidity and credit risk also. This is very important as of today, that the quality of credit will also, and will be intact if these receivables and stock, whatever inventories, they are to be properly valued. Invoice discounting channels are, these are all Very importantly, they are scaling to cumulative trades 1.9 lakh crore. And it is very important, 48,000 crore transacted in 2024-25, such a mammoth amount. While SIDBI's discounting volumes reveal both progress and persistent coverage gaps. These dynamics translate into stretched working capital, margin compression, and the episodic provisioning. That is the very important issues that outcomes no company or bank can afford. NBFC and microfinance packets presents concentrated audit risk. Empirical analytics show multi-lender exposure among NBFCs and MFI borrowers fell from 25% to 17% in March 2025. After responsible lending, a lot of we have a responsibility they are bestowing upon, but the responsible lending quadrials, which provisioning and fresh slippage rose in some quarters, emphasizing the need for sharper field verifications and end use of checks. These have been depicted by ICRA. In ICRA's industry such. That means we are doing this session on receivable stock and end use of funds. These are very, I think they're very timely we have come out because ICRA's observation is very important for entire banking community. And these are not mere accounting entities because this is a very dynamic type of audit. They are real-time, determinants of working capital efficiency, cash flow resilience, and corporate governance also. Inventory overstatement or weak custody controls distort profit and cash flows, and aging receivables, concentrated counterparty risk also, and unverified end use undermines leader confidence and regulatory compliances. And we have seen regulators are clear. MCS Caro 2020 tightens inventory and loan disclosures. RBI and industry bodies stress granular borrower in monitoring and strengthened end use oversights, and banks are formalizing this. The special monitoring framework and agency for special monitoring framework is very important aspect of banking industry. Our mandate is to convert this ledger lines into audit grade evidence through data driven receivable verifications, risk based stock validations, and lender acceptable and end use certifications. Practical action is straightforward: deploy continuous assurance, combines analytics, and very importantly mandatory documentary checklist, e-invoices, ERP reconciliations. These are all coming under this purview as of today's process of inventory valuations, targeted physical verifications, and a coin size auditor certification for end use. This approach elevates governance, reduces credit friction, and also protects the liquidity. And most importantly, the income tax department has mandated CMAs as per section 142(a) inventory valuation, while several PSUs and cooperative banks have already entrusted CMAs with stock audits. And beyond this, SEBI has also considered CMAs on various assignments, and by the IBA has empaneled our various CMAs for conducting assignments on the agency for specialized monitoring. So it reflects the professional recognitions role across the entire BFSI ecosystem. So in this juncture of time, it is our responsibility to learn, to relearn, to unlearn many things, because a lot of in the banking sector we are having a lot of case studies. A lot of case studies will show. I expect our speaker will be definitely delving on certain case studies which will help our practicing CMS how to deal with the real life situations, stock audit, inventory audit, receivable audit, and also monitoring how they should also help the banks to monitor, because this is a stock auditor's role is not, it's a complementary nature. They will be helping the banks. So as a stock auditor, we have got a lot of responsibilities for the protection of the, so that the slippage of the accounts does not happen. And banks should also have the clear early warning signal for that, because stock auditor can also really help the banks to understand how the accounts is going to be behaving in terms of the banking pedagogy. With this, I welcome you all. Let us all listen from our speaker, and I'm sure everybody is here to eagerly waiting for. But as a customs, we have to give this introductory remarks because we also understand that our understanding should also be conveyed to the general members at large. So with this, I welcome you all and be with us, and we shall be holding such program in future in continuous way for your relearning and learning and unlearning. Thank you.
Thank you, Chairman sir, for your wonderful address. Now I request Sumitra Raghavan madam to start her presentation. Welcome, madam.
Thank you. Thank you, BFSI Board Chairman, sir, Partho, sir, Dipendu, sir, for this opportunity. The keynote address was very, very enriching, and I expect that I will be able to live up to everyone's expectations, and wish you a very happy and prosperous Durga Puja and Navratri. With this note, let us start today's session on receivable and stock audit and role of CMA in receivable stock audit and monitoring of end use of fund. I just take a moment just to share my screen for this webinar, and then we will be ready with it. Yeah, I hope now my screen is visible to everyone. Yes. Though in the keynote address, we have discussed about the emphasis or importance of receivables and stock, I would like to reiterate this particular purpose once again. Why receivables and stock audit is necessary? And if the participants can post their queries in the chat box, if they have anything, I will be happy to take it up once we complete the webinar discussion. So why this receivable and stock audit is necessary? Prima facie, in Indian banking environment, the traditional form of credit facility which is given to a business is the working capital facility. That is how much money they require to maintain their day-to-day business operations, to run the business operations smoothly. Now, one of the most important parameter to determine the amount of fund required for working capital depends on both receivables and the stock of an entity. That means the bank primarily funds the receivable part, which the borrower anticipate to receive in sometimes in future, and the stock part, which can be raw material, a work in progress, or a finished good. So entire assessment depends on these two elements of the balance sheet, which are part of current assets of the balance sheet. Now, why I am emphasizing on the word current asset? Because current assets are the assets which change their form in a very short period of time, maybe within an operating cycle. So what a borrower is estimating or projecting at the beginning of availment of loan, the situation may change drastically within a shortest span of time. The borrower may say that I have realized the money, or the borrower may say the stock has become obsolete, or the debtor has become bad. It becomes very difficult on the part of the bank, which deals with n number of such MSME customers, to actually assess the genuineness of the stock and receivables. Hence, to maintain the to check the quality of these two primary current assets and to check their presence and contribution to the business, they have to rely on experts like CMA for stock and receivables audit. It is impossible on the part of the bank to get into the granular level of the movements of stock and receivables at frequent interval. Hence, the expertise of professionals are requested, and that helps banks a lot in maintaining the quality of loans. Now, when the stock and receivables quality are checked from time to time, that automatically helps in monitoring the end use of fund. How that happens, that we will discuss in depth based on certain cases. I have taken certain cases from well-known companies in Indian economy that went bad, that had NCLT issues, and I will also pick up certain MSME examples that I have personally handled as a banker over a period of time. So, with this note, I would say that receivables and stock both are the lifeline of a business. If it is not properly checked, then definitely stress will arise in asset quality, which may lead to a jeopardized situation. To arrest those situations, certain regular monitoring is required, which is technically known as receivables and stock audit. And what role the CMA can play in this receivables and stock audit, that I will explain based on certain case studies, certain checkpoints, and at the end I will summarize the entire role based on this discussion. So, first and foremost, what are the challenges that we find in the receivables and stock? As we all know that receivables and stock constitutes 80 to 90% of the current asset of a entity. So when an entity, let us take an entity requires 50 lakhs of working capital facility. But in reality, maybe the balance sheet is having capacity to only get a loan of 25 lakhs. Now he wants to do some juggling in the balance sheet and get a higher amount of working capital facility. In that scenario, one of the easiest way to inflate the requirement is to inflate the receivables and stock, because cash and bank balance that can be easily cross verified from the account statement. Now we have income tax being mapped with PAN, Aadhaar, everything. So from past data we can get a trend. Fixed assets cannot be built up in a day or a month, or it is not possible to create such a bulging figure of fixed assets. The assets which are most vulnerable in the balance sheet is the stock and book debts, because today I can show that I have to receive 20 lakhs of rupees from Mr. X. Tomorrow I can show any justification that I received it in the form of cash, that I received it in some other account, that the amount which I received was used to pay back my creditors. Similarly, with respect to stock, it is not possible on the part of lender to count and go and check each and every stock in the godown or the unit where it is stored. Hence, the challenges arises. Now, what kind of challenges arise? Each of the challenges I will explain with respect to real life example that we have faced in banks. First and foremost is the question of existence. Whether the receivables and stock which is shown in the balance sheet, or which is estimated projected, or which is shown in the stock statement by the borrower on monthly basis, that is genuinely present or not. This particular challenge becomes more complex if the credit facility is sanctioned by way of multiple banking or a consortium advance. In a consortium advance, the lead bank takes the responsibility to check the stock statement and allocate the drawing power. That is the ability to withdraw the fund from the account based on the value of receivables and stock. As I said earlier, they are the primary assets based on which working capital facility is sanctioned. But when it comes to multiple banking, the challenge becomes even more multifold, because the borrower will give different stock statement to different banks who are granting facility under multiple banking, and we never know the stock which he is showing in the other bank, the same stock is being shown to my bank as well. That means possibility of double financing. So the question of existence comes into picture. Now I would like to share one experience here. There was a customer that was dealing with us, and there were evidence of stress in that account. Frequent overdrawn, non-submission of papers on time, frequently asking for excess of credit facility. All these red flags were present in the account. Once we appointed stock auditor as per the guidelines prescribed by RBI and banks, the borrower was reluctant to engage the stock audit at that point of time. He was saying, no, we are going out for a vacation, this, that, like that. Again, after a month, we again started the process. This time, the borrower simply did not allow the stock auditor to enter the factory. And he raised multiple things. It is not informed to us by the bank earlier. Many issues he created. Then we could make out that now the condition of account is going beyond manageable level. What we did, we checked the list of some debtors which is provided by the borrower in the public domain. That means one of the major borrower was a company. We checked the details of the company in the MCA website. And to our surprise, the address of this receivable, that is the debtor, was same address as mentioned for the borrower. That means they were sharing a same premises, and this particular debtor was amounting to 80% of the total debtor of the borrower. Now, what is the first question that will come to a mind? Is this a shell company which is uh, adding to 80% of debtor of my client? The client is not supporting for the audit. There is no realization coming up in the account. Then it is a shell company. Then we deep dwelled into the details. Then we also saw that the authorized capital of this entity, the debtor, was 1 lakh rupees, whereas the dues which was due to our client by this debtor was close to 2 crore 80 lakhs rupees. Now, a company with authorized capital, how it can take borrowings of 2.8 crore, and how a businessman can rely on such debtors and do not create a provisioning. So this is the challenge and dilemma of existence which comes into picture when we work on very fungible, I would say, because they keep changing forms, fungible assets like receivables and stock. Next comes aging and quality. The aging and quality is also very, very critical in these two assets. The reason being, how we classify these assets in the financial assessment for working capital facility depends on their classification. Apparently, they are classified as current assets, that is, which is realizable in a period of 12 months. But the real life business scenario is not so easy. It is full of bumpy rides, right? So, in assessment of working capital, receivables which are possibility of getting realized beyond 6 months, they are generally classified as non-current assets. And similarly, in case of stock, when it is observed that the holding period of stock is quite long, of course, the nature of business plays a very important role that determines the operating cycle. But if it is unnaturally long, say more than 1 year or close to 2 years, then that is also a red flag which must come, because the stock is not moving. What is the reason the stock is not moving? Why should I consider them as a current asset? These all questions must come. Again, with respect to aging and quality, what happens is that the customer on a regular basis provides a stock statement to the bank. I'll come based on this red flags, I'll come to the audit part through case study, but here I am discussing the initial nuances with respect to receivables and stock. So when a customer provides a stock statement to the bank, they have to provide details like breakups of the stocks, be it raw material, working progress, and finished goods, quantity which they are presently having, price per unit, and total quantity. Similarly, with respect to debtors, they need to provide with aging of the debtors. Why aging of the debtors becomes necessary? Generally, the age bracket is 0 to 30 days, 30 to 60 days, 60 to 90, beyond 90, like that. Why aging becomes necessary? Because when a credit facility is sanctioned, the holding period is assessed by the bank. That is, what is the general average period of time to get the amount from the debtors and also to realize the amount by selling the stock, right? So if a holding period on an average is 45 days for both receivables and stock, but when the stock statement is provided, if we find that majority of the stock is towards the period 60 to 90 days or 90 days or beyond, then a question must come, why this deviation has happened from the estimation projection and the past trend? What is the measure that the client is taking to reduce this diversion in the holding period? Was the estimation projection genuine, or was it certain exaggeration of facts and figures based on which the lending decision was taken? Because the borrower need to also, it is not about becoming an account becoming bad or good. It is also because borrower has to maintain certain covenants which are stipulated in the sanction terms and condition. And maintenance of covenants somewhere or the other depends on the quality of receivables and stock, because the flow of fund will get realized from these two primary assets only. So here, with respect to aging, I would like to share another example. There was a client, though it was dealing as a sole our bank was the sole banker for this client, but this entity availed multiple short-term loans from many NBFCs. And overall gearing ratio of this client was very high. Again, a stress in their balance sheet, account coming to SMA 0, 1, 2, like that. And the transaction in the account was very, very limited. Now, every month, after tremendous follow-up, we used to get the stock statement from the client. And what we used to find that they have given a very healthy receivables figure. Drawing power used to be very sufficient based on the receivable and stock figure. Obviously, if a customer provides more than 3 times of the value as a stock and receivable, the drawing power, considering the margin of the borrower, will definitely arrive. There was no shortage of drawing power. But the calculation of drawing power is not the ultimate thing. Then what we started observing is that we started checking the stock statement for past 3-4 months, and we checked which are the debtors who are catering to 70 to 80% of its complete receivables, and we checked whether there is a stagnancy in those debtors or not. To our surprise, those debtors figure was constantly same month to month basis. But when we took the summarized figure of uh, debtors more than 90 days or so, the borrower had submitted debtors more than 90 days is nil. Again, I repeat, when we are reading the trend on month-to-month basis, based on the stock and book debt statement submitted to us, we are seeing stagnancy in the value of debtors over a period of 6 months. But when the borrower is submitting age-wise debtors detail, none of the debtor is more than 60 days. They are showing everything is within 60 days. So when such kind of contradiction arises, then also we should raise a question that the trend and the aging which is mentioned is completely contradicting. Why is it so? This also becomes a situation to probe into the details. Similarly, in case of stock, the quality of stock also becomes very essential, because if the quality of stock is not good, either it cannot be sold in the market, or it has to be sold at a price much lower than the cost price for the borrower, and they have to incur a loss in it. I will discuss a case, and I will then discuss about the quality of stock and its necessary. It is a real life case, and it will be very interesting to note that case in the next portion of this webinar. I'll discuss this, right? Then comes liquidity. Uh, the fundamental of a working capital facility is that from the realization of debtors and stock, whatever fund will come, that will be used for the maintenance of the working capital facility. That means servicing of the interest, maintaining the operational expenses, everything. But if the fund gets stuck in the receivables and stock, how can the business run? The churning of the business will not happen, and it may lead to a situation that borrower may be requiring a frequent excess of facility, or the borrower may start defaulting the repayments. Another reason why receivables and stock audit is essential is they are considered as the primary security for the working capital facility. Primary security means tomorrow if the borrower defaults, bank will rely on these two assets of prima facie basis to realize their dues. But in practical banking scenario, what happens when an account becomes NPA and bank tries to initiate action via SARFACI or any mechanism, the at the end what they find in the balance sheet, the receivable or stock is written off. Nothing is realizable from the receivables or stock, and they find that whatever figure was provided to bank from time to time, that did not exist. It was only in the financial statement. So this is the reason, as the bank encumber this receivables and stock as their security, it becomes prima facie essential to get this details checked, verified, and scrutinized through a process called audit by expertise like all of you who are participating in the webinar today, that is the CMAs. Then the next factor is prevent overfinancing. As the bankers cannot check the stock and receivables end to end, even while granting the credit facility, because receivable largely remains in the book. There are certain process to cross verify, test, check, which we will delve in detail. But when the financial statement is checked, it appears only in the form of certain numbers, right? And if receivables are company, then certain prima facie due diligence can be done from MCA, but nothing much can be done at that level. Similarly, with respect to stock, when bank goes for inspection, though they can see the certain items are present in that unit, but it is not possible. It is just an eye view estimation they can make. It is not possible to sit and count how many item A is there, how many item B is there, and do inspection in that level. So there are high chance of overfinancing, which we will also witness in our cases. To prevent such kind of overfinancing, banks has to heavily rely on the stock and receivable audit process. That is why when most of the time such audit is done, and in stressed account, the auditor points out there is um, the DP is excess. That means the value of receivables and stock is less as compared to what is given to the bank. Then immediately bank has to action on it by reducing the drawing power in the account. And then comes a dilemma whether to wait and watch or what to do. We will discuss these scenarios. Then check the quality and movement. Quality and movement means whether there are concentration in terms of receivables and stock. That means my receivable is only one entity. I remember there was one company, very compliant entity, and good with payment of statutory dues, good with payment of everything, very good client of the bank. The only challenge which they had was that they were manufacturer of glass bottles, and the only challenge in their business was their 95% of receivable was Kingfisher. So when Kingfisher started facing a business wrath, and Kingfisher could not, the UB group could not sustain their business, this entity had a big blow. They could not pay their statutory dues. Lot many legal complications started. They started encountering. They started defaulting banks repayment, and they went into stress position. From there, after a period of time, they started reviving. So it is also essential to check whether the receivables are concentrated. If it is concentrated, then what is their quality? How viable they are? How good is the repayment received from them? Similarly with the stock, if a key stock, this happens in case of cement industries, that they are heavily relying on certain renewable non-renewable resources, and if the supply is not perpetual, the entire functioning of factory will stop. So what is the source of such material? Is it available from nearby vicinity, or are they having any long term contract for its procurement? How is the terms? This all also comes into picture. So how we can navigate through the journey of receivables and stock audit, and how being a professional we can support the bank in these aspects, more understanding we will get as we proceed with the cases that I have come out for everyone today. Meantime, if you have any queries, you can definitely put it in the chat box, and I will be happy to take it up. So let me come to the part of inventory. Inventory has three major components: raw material, work in progress, and finished goods. Now, I will talk about all the three elements with respect to stock audit, right? What is the role of raw material? I am procuring certain basic fundamental items. Say, for example, it could be certain paper for preparing a corrugated box. So the raw material gets converted into work in progress, right? If a customer whose intent is to defraud a bank, generally he will not show a very long raw material holding period, because it will be very evident to the stock auditor as well, until and unless it is based on their operating cycle. But it will be very glaring to the stock auditors and bank that raw material is sitting in the books for 4 5 months. The very obvious question will come that why your raw material is kept like that. Is there any issue with your machinery? Is there any issue with your power, labor? What is the reason? So generally, he will maintain a sanity in maintaining the operating level of raw material. So a lot of fudging will not take place at the raw material level. Now let us come to the finished goods part. Finished goods part also will not stay in book for a longer period of time until and unless the nature of business demands. Say for example, in certain case it requires inspection, test checking, these things are required, right? So it may take time when it is a government contract and all those things. But generally it is not possible for a trader or manufacturer that I have finished goods, but I am not dispatching it to my client. One reason can be my goods are no more sellable in the market. That can be one reason. Otherwise, if I have demand in the market, I cannot sit with it for 6 7 months like that, right? So where should the emphasis come largely? The larger part for manipulating or enhancing the value of stock comes in the work in progress part, because work in progress is a transition between the phase of raw material and phase of finished goods. And being banks, when we go for inspection in a quarterly, half yearly or an yearly basis, for a one day, it is very easy to justify to a banker, this is a work in progress process, this is in work in progress process, it will take 2 3 months to get converted into finished goods. And at that factory or unit inspection, it is not possible for a bank to get into the technicalities, check into the details of the books, the accounting entries and everything to cross verify this fact, right? And when it is again joint lending in the form of working cap, multiple banking and consortium, it becomes even challenging. So what bankers do, they generally ask, okay, what is your working progress process? You put it in this machine, then it is done this, and the output is obtained, and then we put it for the finished goods. Mostly, in most cases, bankers get satisfied from the answer. But when a professional role comes into picture, the emphasis is expected to be large on the working capital, working progress part. What is the process? How the books of accounts are maintained? How working progress is valued in the books? These things comes into picture. Again, in the case, we will delve how working progress was manipulated. So if we break the component of the stock, the larger emphasis in a stock audit is required in work in progress, not only in terms of their valuation, not only how they are arrived at, how many days generally the work in progress is in the books, but also what is the quality of work in progress and its valuation. Before I move, again, I would like to share one experience. There was this client dealing with the bank for quite a longer number of years, having a very good relation with the bank and also in the good books of the concerned bank, right? They used to frequently request for excess or ad hoc facilities. And one day they submitted their balance sheet. Okay. In the balance sheet, we have notes to accounts, everything, right? In that notes to account, it was mentioned that the closings, what is the general fundamentals we consider for valuation of closing stock? Cost or market price, whichever is lower, which is the conservative mechanism of valuation, and it is valued removing the profit or loss element of it, right? In the notes to account of this particular entity, it was mentioned that the stock was valued at market price. Now, this may the borrower was saying it was a wrongful statement by the auditor. We will provide you addendum, all these things. Setting aside this technical part, what is the uh, emphasis? What is the significance of this statement? That means till today, whatever drawing power was allocated to this customer was inclusive of the profit element, because the stock was valued at market price. That means cost plus profit was included in that price. That means bank was also funding the profit element of it. In other word, it was an excess borrowing on the part of the borrower. And continuous excess borrowing over a span of time beyond 3 months, what do we call it? We call it that the account is in excess borrowing for more than 3 months. Let us classify it as a stressed NPA. So this could be the repercussion of just one single statement in the financial statement. That is why all these nuances become very, very essential when we deal with the stock and book debt audits. Now, what are the pointers which we can consider when we take up the stock and book debt audits? As I discussed with respect to working progress, first and foremost, whatever stock is there, whether it is in the form of raw material, work in progress, or finished good, we have to check what is the use of it. First, understanding how they are used in the final product of the borrower. Then, period of use. Period of use helps us to tell what is the duration of this element with respect to their holding period. Third very important factor comes is the internal control. How each elements are controlled by the borrower, whether they have proper record of it, how they are recording, whether each element, each of the item, because there can be n number of items in the stock, how these items are maintained, how inventory management is done at their level, how they are preventing any fraud at their unit, how they are preserving the quality, how the insurance is maintained. These things comes into picture. Their existence, whether they are actually present at their unit or they are providing these stocks to certain other third party for job works. If such thing is done, then how the record is maintained. As I told in previously also, if any raw material which are scarce and for which they are highly dependent on one or two supplier, whether agreements are available, whether the agreements are active, valid, these thing is also essential. Records. I discussed earlier how the books of records are maintained. Rights of ownership. What is their position with respect to its ownership, whether there are any remarks in the books pertaining to their ownership in the balance sheet, that becomes critical. If they don't have ownership and they are having a DP from us, that becomes a challenge again. Here, again, I would like to cite one example. There was a tea industry financed by a bank, and the tea industry was highly stressed. They wanted to sell one portion of their tea garden to some other entity to monetize that asset. But due to several non-compliance in their account, bank did not give the NOC to them for selling a portion of the tea garden. Then, considering the monitoring part, bank allotted for the stock audit. The stock auditor went to the tea garden, and one day he came to the branch and he said, Madam, I have a very strong observation. I asked, what is your observation? He said, this particular borrower is not producing the teas in his own brand. When I went there, some other brand of tea is being manufactured, and I was not allowed to enter the factory. I could not enter. Then we started connecting the dots. Though the bank did not provide NOC for the sale of the tea unit, but they made an internal agreement or understanding with each other. Okay, you start manufacturing in your brand here and you pay me. Once the legal part with bank is done, then we will settle our legal agreement. Imagine a situation, somebody else is producing some other brand and this guy is showing the DP to us. We are giving drawing power based on his statement. Immediately based on this observation of the stock auditor, we initiated many other measures like classifying the account as non-cooperative borrower and other things. But this is the role of a stock auditor, in turn a role of a CMA when such cases are being handled, to come back to the bank with a high level of transparency observation that aids bank in maintaining the quality of asset and taking critical decisions on time. Yeah, valuation part I had discussed earlier, cost or market price, that example. Disclosure, how they are disclosing things in the balance sheet, in their returns and everything. With respect to disclosure, I will discuss a case in few minutes. Auditor's report. What is the observation of auditor in their report? One very common observation is the value of receivables is determined as certified by the management. The stock, we could not count the stock, we could not check the stock in detail, but the management has certified that the stock is so and so. So when and at times the observation also comes, debtors confirmation to us is not yet received. However, management has certified debtors as so and so. So when management certification is too much in number, that is also an alarming point for us to observe. Whether they truly exist or not. Even in companies like Raymond's, there were observation with respect to stock that they are saying that stocks are at port. We are not having the control over the stock right now. So that also become an observation to consider when evaluating the health of stocks. Then another very good instrument which is available these days is the CARO report, Companies Auditors Report Order 2020. There are 21 clause, and majority of clause is very useful with respect to receivables and stock, about their valuation, about quality of receivables, about whether there was overstatement of stock and book debts by the borrower. All these things, it has to be certified. So that also gives lot of insights with respect to stock audit. And before doing the stock or receivable audit, going back and referring to CARO report also gives quite a good insights, right? Now, this is a case study which is with respect to SR Steels. We all know SR Steel, right? So The last balance sheet which was available for SR Steel was 31st March 2018. After that, no balance sheet is available in the public domain. As I discussed earlier, working progress becomes very critical element of the total inventory. In SR Steel, what we had observed, it was 68%, 72%, 86% for 3 continuous years. At that time, company was running into loss. Over the year, the loss was increasing. You can see there was a quantum jump in the loss figure from FY17 to FY18, right? Almost 3 times. Now what happened? When after reading this trend and when the account became stressed, bank started initiating actions and everything, what was evidenced? On perusal of working progress of the entity, it was observed that 30% to 40% of the working progress was classified as others in the balance sheet. That means majority of the majority of the inventory is working progress, and out of this working progress, 30 to 40% of them were classified as other assets, right? And no details was provided to it. There was no details of it. On the contrary, even a small items of 3-4 crore was having complete details in the balance sheet. Isn't it highly suspicious that a 3 or 4 crores of entity was having complete detail in the balance sheet, whereas 30 to 40% of it 30 to 40% of it was not having any remarks in the balance sheet. And a company having such big balance sheet figures, 30 to 40% can be a humongous numbers. So this is also a criticality which has to be looked into when we are studying the receivables and stock from an audit purpose. What is the balance sheet speaking about it? What is the record speaking about it? This information becomes essential. I hope I am clear up to this and the progress is within the scope as expected, right? Now comes a situation where I will delve into the debtors part in detail. See, one hand, if we see a balance sheet, stock is high, debtor is less. What it will indicate? That stock is getting piled up, probably it is not getting sold, so it is not getting converted into debtors. First, if debtor is high, stock is less. That means what we will feel, okay, stock is reducing. That means finished good is prepared and sold out, but debtors it is not converted into cash. We are having problem with monetization of this debtors. Now, if both stock and debtors both are high, what we will feel? It is a very rare scenario that can happen that both stock and debtors are high. Then company will be in a choked position. Neither they are able to get rid of stock nor they are able to realize from the debtors. There is no point in running business in such situation, and no one will prefer to reach to that level without taking any action, right? So this has to be also checked when we are taking up the charge of stock and book debt audit. How is the trend? Is growth increasing? And if it is increasing, what is the rate of increase? Is it something violating the general industry trend? This has to look into. Then, as I told you, many a times we come across a remark that inventories are valued and certified by management. This statement, though it is widely used, it has to be taken into account with respect to other parameters like how is the conduct of the account, what are the red flags, how the stock statement speaks about it, how the factory is maintaining the inventories and books of records. Based on that, we have to lens through this particular information which is available in financial statement, because many a times many serious observation gets hidden beyond this veil of this particular statement. So this has to be checked. Then with respect to receivables, what we see is that they are wrongly inflated and deflated. As I told you about a customer, they were sharing same address. It was a shell company like that. And receivables from A is shown as receivables from B. This is also quite common, and related parties are debtors. That is very, very common. Related party can be a debtor, and banks can choose to provide a drawing power against it, provided they need to ensure the transactions are based on arm's length basis. It has proper disclosure, proper detailing and justification in the appraisal. These things are there. Now, regarding receivables, a fundamental due diligence which the banks do is that they check who are the top debtors. If their information can be available in public domain, that they check, and then debtors confirmation letters are issued both by the auditors and the banks also at frequent interval, where funding is majorly based on debtors, and they try to get a confirmation that this is the outstanding. In my banking experience, I have seen when in many cases when we go for confirmation from debtors, we have got reply that we are not having this much of outstanding dues. We have got a reply that we don't deal with them. So these things are critical. Read between the lines while carrying the audit activities. Now I give you an example of Ruchi Soya, a very, very popular entity taken over by Patanjali Group. So here what happened, in spite of decrease in sales by 40% in financial year 17 against financial year 15, the trade receivables remained at same level. So observe the situation. Sales reduced by 40%, whereas receivables remained intact. That means there was no movement or realization in the receivables. Trade receivables, which was forming part of 19% of the revenue in 2015, it increased to 1/3 of its revenue in 2017. Look at the level of jump, increase in the trade receivables from 19% to 1/3 of the revenue. That means it was bulging in their books, sitting heavy like white elephant in their balance sheet. Now in FY 2018, what happened? The net loss was 5,573 crores. Prior to that, the level of loss was there, but it was nominal. Why this 5,573 crores of loss arise? Because the debtors which was bulging in their books, it was suddenly written off. And 5,000 crores of debtors was written off from the balance sheet in the year 2018. And this 5,000 balance sheet which was written off from their books, that impacted the PL and led to a net loss of 5,573 crores. Now, what was the impact of this? When the bank went for a settlement of the loan, bank took a haircut of 60%. And this 60% haircut which the bank took, that was close to 5,000 crore. So who was the ultimate sufferer? It was not the Ruchi Soya who wrote off the receivables in their books. It was the bankers, because this fake receivables of 5,000 crore, that loss of fake receivables was impacting the capital of bank by way of writing off from the books. So it was us, the public, whose money and multiple things that got written off in the form of the receivables in Ruchi Soya case. So this kind of inflated figures of receivables are big threat. So this trend analysis is essential when we check them. As I discussed earlier, both stock and debtors increasing together is one of the major red flag. Here I would like to discuss case of Alok Industry. Again, a very popular name in the Indian market. From 2013 to 2017, inventory levels were close to 5 to 8 months of sales, and debtors were outstanding equal to 9 months. So inventory holding period was 5 to 8 months. Debtors holding period was almost 9 months. Okay. As a result of huge inventory and substantial debtors, the combined amount of both was more than sales of full year. Say, for example, inventory was 200 rupees, debtors was 250 rupees. So together, what was the value coming to? 450 rupees. However, the sales was somewhere in the books as 300 rupees. That means the value of revenue is much lesser than the stock and debtors. Another observation, what it is, the holding period, the number of months. If we club inventory and stock together, they are beyond 12 months as a holding level. In 2018, company incurred loss of 18,207 crores against a loss of 3,052 crores in 2017. So in 2018, the loss increased almost 6 times. And this was due to writing off of inventory and debtors. So close to 13,000 crores was written off in 2018 from their books. This is what the companies does. They keep on bulging the information to certain level, and beyond certain level, when they cannot continue with the heavy weight of the items, they remove it from the balance sheet and simply show it in the form of loss. So what is warranted through the process of stock and receivables audit, to come out with the observations much ahead of time with accurate transparency, and help the lenders to take some actions before such situation are encountered. Now, I would like to summarize the role of a CMA with respect to this based on the points that we have discussed. First and foremost, what is expected when a revenue, receivables and stock audit is undertaken? First and foremost, to understand what is the scope of the stock and receivables audit. This I'm telling from a bank's perspective point of view. So what is the scope expected from the bank's point of view? I tell you, one of the stock audit reports saved bank from issuing a accommodation LC of 5 crore, because in the stock audit report, the auditor clearly mentioned that we were not allowed to check some of the stocks. It was told to us that these stocks are not financed by the bank. And he also pointed out, though the borrower is in manufacturing business, but they are largely doing trading activity. So all these inputs help the bank to prevent any misconduct, right? So first and foremost, understand the scope of receivables and stock audit. At times it can be a regular activity as compliance, at time as sir said, ASM activity, at times it can be in NPA account, or it can be a consortium or multiple banking account, or it can be after a red flag in the conduct, especially it is assigned. So first is scope. Second is to get details of the customer from the bank in terms of account transaction, certain feedbacks, was there any overdue, are they regular with respect to submission of stock and book debt statement, are there any past remarks with respect to stock audit, any audit observations are there. This gives an idea primarily about how the customer is, how bank is viewing this customer to be, and the financial statement, these things has to be checked. Based on this, a thorough study has to be done based on this data. Then a unit inspection and books of accounts, how they are maintaining the books of accounts, what is the quality, how the records are maintained, these things, the unit is functioning, the valuation part, the payment, the dispatch and procurement part. Then when any observation comes to them, as when they witness any observation, that has to be with high transparency and high level of ethics need to be discussed with bank. That can be an overvaluation of the stock, absence of stock, quality of stock being very poor, anything like in this tea industry which I had discussed. The stock auditor also said, Madam, the factory is seeping and pile of tea leaves are just simply dumped there. And the tea quality is getting deteriorated because of seepage from the ceiling, and no one is undertaking any repair activity. But when it comes to stock statement, 100% good quality stock they are showing, and they were taking the DP. So this part is essential, that what you witness, what you sense, and to transparently express it to the bankers and support them with a decision. Then to documentize the observation and also provide supporting documents to the bank as evidence. And then a remark can be given, it is advisable that drawing power is high, or to discuss with the borrower, or if drawing power shortage is suddenly arising, why it is arising, your remarks has to be given. And then uh, based on that, to support banks if they seek any suggestion as to how to proceed further with it, that also comes into picture, because many a times due to long term commitment, other business requirements, or certain other challenges of DLP, bank may seek advice from experts like CMAs as to what is the next step, whether there are any what is the level of risk they are envisaging in that account. So that expert support has to be also extended. And also to leverage the use of public domain these days to a large quantity in doing this audit, because we can check where the debtors details online if they are company, we can check the GST details and the HSN code online in the GST portal. Address verifications can be done. Then e-way bill details can also be checked online these days, and certain information about stocks, nature of stocks, these things, their average pricing, these informations are also available online these days. Tin details can also be cross verified when bills are being checked. Then tin details can also be cross verified through online portal these days. So lot many study before going into the activity of receivables and stock audit on field will give a good idea as to in which category we can basket this customer. Is it high risk, medium risk, or low risk? So accordingly, we can approach the on-field activity, identify those items of stock which has an unnatural trend in their books, or which whose value are humongously high with respect to their book, concentration is high with respect to their books. And when a customer also shows hesitation or is not cooperating, that has to be highlighted also from the to the bank from time to time. We have seen certain auditors who are very proactive in informing banks about these things. Again, we have seen some auditor, after follow up from the bank, they used to come and say, oh, he is not entertaining or he is not picking our phone calls. So timely interaction and coordination between the bank and auditors is very, very essential. So with this, I finish my deliberation here. Quickly, I'll check if there are any queries. Or if you have the unmuting part, you can unmute and raise your queries quickly for 2 minutes. I will take it, and then I will hand over the dais to the um, BFSI board and the coordinators. Okay. Uh, I have one query to take up. Is there any benchmark for receivable and stock for different sectors? Generally, as per from the lending part of view and from RBI guidelines, it is the amount of working capital limit which is to be taken, which is 5 CR. In case 5 crores of limit in working capital, either in sole banking, multiple banking, or consortium banking, that has to be purview, that comes under the purview of receivables and stock audit. And there are no, is in case of stock audit, see, in case of stock, it is the stock which is available in the factory. In case of receivable, we have certain tools to check, like what is the figures of receivables in the balance sheet on YOY basis. Who are the major receivables? Whether confirmation is obtained from those debtors, the major receivables. If they are a public limited company or a company in public domain, can we cross verify and check their credentials? How is the movement of fund from those debtors from time to time? These are the some of the checkpoints which we need to do. And when we go for audit, we have billings with us, we have invoice with us. So based on those invoice and based on account statement, we have to reconcile whether the what is reflected in the invoice, that is reflected in the account statement or not. And in dispatch register, we have to see whether the stock was dispatched to this receivables or not. These are the, and confirmation of debtors, these are the some way where we can do the due diligence, right? So I don't find any further queries here. So I hand over the dais to the Bindu sir.
Yes, ma'am. I think I thank you, ma'am, for your wonderful presentation. We
Thank you.
learned a lot from the practical case studies, and we hope it is useful for the members. I think more than 121 participants as of now, they have joined, and I think one question, I think just you can see the last.
Yeah.
Yeah.
Does bank get DNB report for customer? See, DNB report is largely taken when it is trade finance. When there are facilities like letter of credit like that. Otherwise, DNB reports is not taken. In case of debtors, the general due diligence is check MCA. If you can fetch the CIBIL report of the debtor, that is fine. then checking the TIN numbers, checking the address, invoices while going for the audit, and account transactions. These are the general phenomena which is taken in domestic activity. DNB is applicable in international trade, trade finance, especially in case of documentary credit. Yes. I hope I have answered. Yeah.
Another question is there, madam. In case of stock audit, the physical inspection.
This I have discussed, sir, that for receivables we have to check the MCA, their address, invoice, account statement. When we go for physical inspection for debtors, check the tally part. Tally part means the accounting part, how the ledger of debtor is maintained. That much only we can do, but physical inspection largely 80% meant for inventory. Yeah. I hope this one is answered. Yeah. Yes, sir.
Yes, ma'am. I think uh, everybody has gained from your presentation, and we would be sharing the PPT also in our
Yes.
this BFSI portal. We'll upload that,
Yeah.
and recording in the YouTube channel of the institute. We'll
Sure.
upload the full session. I think with this we close today's session, and thank you,
Thank you,
Madam
sir.
Sumitra Raghavan, Madam, for being a part of this webinar, which has given a lot of practical insight. I think another question has come, Madam, if you can answer that.
Okay. Is there any library even? Uh, no, such liability won't arise. Only thing, when the facts and figures are pointed out in the report with accurate transparency and it is documentized with necessary evidence, then no liability will arise. If any facts and figures are intentionally misrepresented, and if there are trend with respect to that auditors in that bank, then they may depanel the auditor. Otherwise, no liability will arise when account becomes NPA. No one will charge them in accountability part. But reputational risk will continue if such trend is available in multiple accounts in a particular bank, and if it is found that intentionally certain data are misrepresented. Yeah. Otherwise, no risk is there.
Yes, ma'am. I think we will call it a day because we have crossed our time limit,
Yeah.
and I thank wholeheartedly to our chairman, CMA Chittaranjan Chattopadhyay, for encouraging us to organize these practical webinars on a weekend. And I thank our advisor of BFSI board, CMA Partha Chaudhary, for his special address, and our BFSI board members for always encouraging us to organize more activities in the BFSI sphere. We thank our BFSI team. We have a small team, Roop, then Indrakshi, Shantanu, everybody for cooperating for this event. And we thank other departments, especially the CPT and also the IT department for making this happen, this webinar on a Saturday. And I thank all the participants, and I hope the coming festive days will be a great days for you. And with this, we close today's session. We thank everybody for their participation.
Thank
Thank
you
you
so
all.
much, sir. Thanks a lot.
Thank you, ma'am.
Thank you.